Hello friends. Last week we basically saw how the markets were expected to remain volatile, and I told you that PSU stocks would remain in the center of all the action, and that is precisely what happened. Now election season is very earnestly in process, and you're basically seeing the markets gyrate to the news, views, rumors, supposed data points, etc., etc., and volatility is really high. This would be a good time for you to enforce the tail risk hedge strategy. Now, this is something that I have been advocating since the last few weeks in my video. I've also basically talked about it in my weekly live mint column, which happens to be India's first and only media column to offer statistical inputs to its readers. Now, what is a tail risk hedge? I've explained it in detail on my free Telegram channel. The hyperlink to that post is in the comments below and in the description below this video. Do make it a point to subscribe to my free Telegram channel. You don't have to pay anything for it. Where this is one place where I share all my news, views, research, etc. under one roof. So, like I said, it would be a good time for you to initiate tail risk hedges and protect yourself from any excessive volatility in the markets. Now, coming back to our usual studies in the market, on your screen right now is the weekly market roundup. What you are seeing is that the Bank Nifty very clearly outperformed the Nifty 50, and there's no surprise there. A couple of weeks ago, I told you that there are more than 5 dozen or approximately 5 dozen countries that are holding elections this year, and economic data and sentiments would be massaged. The heaviest weighted sectors will see the highest amount of buying activity. And hey, the banking and financial sector stocks contribute approximately 33% weightage in the Nifty 50. The other second best weighted stock, the IT sector, does not even hold 50% of the weightage of the banking and finance stocks. So if you want to have a rally in the headline indices, you have to push up banking and finance, which is exactly why banking and financial sector stocks are doing so well. We saw the US dollar index, the Dixie, fall very sharply, and that basically gave a reprieve to emerging market indices, including India. Gold and silver continued to witness profit taking because of the huge rally that they've seen in the last 5 or 6 weeks. Crude oil fell sharply. I've been telling you that I do not subscribe to the super cycle theory in energy at all, and this is essentially a man-made shortage. I've shared many reports on my Telegram channel. Do subscribe to my free channel, please. Now, natural gas prices went up in excess of 11%. Now, this is basically the expiry effect. The April contracts have expired. The May contracts are in place. And let's not forget, the European Union is threatening to impose sanctions on Russian gas exports. So that is another play here. But is there a super cycle? I still don't think so. The USD INR, which is the United States dollar versus the rupee, rose by 11 basis points, which means the rupee weakened a little. The Indian 10-year benchmark bond yields fell by 5 basis points, which means bond prices went up. And who is the biggest investor in bonds? Banks. Which is why banking sector stocks were up marginally, because there was a huge mark-to-market profit, notional profit of course, on the bank's bond portfolio. NSE market capitalization went up barely by 0.5%. That tells you that the rally was broad-based but fairly muted. The US markets provided tailwinds, which is another reason why our markets went up last week. Now friends, I basically want to show you the relative performance between the Nifty and the Bank Nifty over 4, 12 and 20 week time frame. Over a 4-week time frame, the Bank Nifty continues to outperform the Nifty because the Nifty has returned negative returns. Over a 12-week time frame, again, the Bank Nifty has been performing, but over 20 weeks, the Nifty 50 has very clearly performed. Now, for a simple question. These are spot market comparisons. If in 20 weeks, which is 5 months, you're going to get 4.75% return on the Nifty 50 and 1.62% on the Bank Nifty. Do remember, these are spot prices used for comparison. If at all you were to basically factor in cost of carry for 5 settlements, remember this is 20 weeks, you would be out of money. You would be negative. The market is actually giving you negative yields on the indices over a 20-week time frame. So that is something you need to keep in mind. Friends, the market roundup done. I come to the market-wide position limits. Now, this is nothing but the exposure utilized by traders as a component of the exposure allowed by SEBI. What you are seeing is the exposure levels going up, MWPL going up to 36.42%, which is higher than all previous weeks in the commensurate period in the 20-week time frame that this chart is using as data points. Very clearly, big money is still latching on to their positions. They have not surrendered too many positions, and hope and optimism is fairly high in the markets, which is good. But do remember, high MWPL brings along with it high volatility or statistical beta, for the simple reason that in the unforeseen circumstances of any adverse news coming in, unexpected news coming in, you have that much more positions to unwind. Now I come to the stock and index futures turnover. And this is a 20-week time frame. Again, the turnover has come down sharply. Not really surprising because the prior week's turnover spike was also due to the expiry. Now, people tend to square up their April futures and initiate the same trade in May futures. That results in dual turnover. That is why you're seeing a spike every 4 weeks. Now, the real price discovery mechanism will start from this week onwards, and we'll monitor it there. All these data points are something I share on my social media accounts, particularly my Telegram channel. Do make it a point to subscribe to that free channel. Friends, I now come to the NSE advanced decline ratio over a 20-week time frame. What you are seeing is that the advanced decline ratio has fallen below 1. At 0.86, very clearly it tells you that for every 100 losers, there were only 86 gainers. Buying conviction on an intraday basis was frankly poor. Now, in order that the market sees a sustainable rally, prices and advanced decline ratio must rise together and the ratio must stay above 1. Friends, I now come to the Bank Nifty and Nifty prompt month futures basis. Basis is nothing but the discount or premium prevalent in the futures compared to cash. And just like the options premium, basis tends to contract as we head towards expiry. Now, the prior week's lofty levels of the basis, I told you in last week's video, they would be unsustainable because as the euphoria dies down post expiry rollovers, you would see a gradual decline in the basis. Very clearly, there is caution at higher levels, and the basis is another metric that I share on my social media accounts every day. Do make it a point to connect there. Friends, I now come to our in-house statistical indicator, the impetus, which you've been enjoying since more than 3 years now. You won't get this anywhere else on the internet. What I warned you last week was, in spite of the fact that the indices went up last week, the impetus had fallen, which means I told you the rallies were on poor buying momentum. Sure enough, the markets basically appeared sluggish. Do remember, Nifty's gained only 0.25% last week. Now the impetus readings are higher, but there's been selling at higher levels. So there was force in selling. I would want the price and the impetus to go up on both indices, failing which I would say that the markets are nervous. Friends, I now come to our in-house indicator, the lift weight thrust drag index, and You won't get this anywhere else on the internet. It's been standing the test of time for 3 years now. What you are seeing is that the NSE has clocked smaller gains of 0.25 percentage point last week, and the LWTD has fallen sharply from 0.64 in the prior week to 0.26 last week. That very clearly tells you that at higher levels, buying support is flimsy. It is thin. Now, ideally speaking, the price and the LWTD should be going up together, but it's not. That tells you that there is nervousness in the air. Friends, I now come to the bond market, which is very close to my heart, and I have been covering the bond market ahead of all other markets, Nifty and Bank Nifty also, because I feel the bond market funds all other asset classes, and knowing cost of funds is extremely important. Now, the Indian 10-year benchmark bond yield has fallen 5 basis points last week. That means bond prices have gone up. Are we in an actionable zone? Not yet. I want the Indian 10-year benchmark bond yield to fall below 7.06, 7.05 before I try and find a good gilt fund to go out there and latch onto. Or I want the yield to go above 7.60% before I can go out there and start laddering again. Because I've been laddering the Indian 10-year benchmark bond yields from 6.6% in very late 2021 and early 2022 onwards. But I need higher and higher progressive yields before I can continue to ladder. Till then, I'm sitting on dry powder, waiting in the wings with a checkbook. The first place I will update a tradable strategy or investable strategy would be on our free Telegram channel. Do make it a point to subscribe there. Friends, the bond market's done. I now come to the Bank Nifty, which gained only on 1 day out of 4 trading sessions and rose 1.5%. And what you can see on the daily chart on your screen was that Monday was the lone gainer. And then all the remaining 3 trading sessions last week were falling days. The inverted hammer that you saw on Tuesday was at the upper trend line of a rising wedge that you will see in the weekly chart later. Now, the price is still above its month-long moving average, which itself is sloping upwards. So the short-term outlook is positive only for now. The weekly chart on your screen shows an inverted hammer testing the bullish wedge's upper trend line. Note the number of hammers that have been made on this chart in the last 4 weeks itself. Remember what I've been telling you. The weight of the banking and financial sector stocks is approximately 33% in the Nifty 50. So index management and boosting the markets will require the Bank Nifty to be bullish before even the Nifty can go up. Nothing happens in the financial markets without a reason, and the reason is always financial, which is why you're hearing so many noises about banking stocks being bullish. The price remains above its medium-term moving average, so the medium-term outlook is positive for now. Bulls must defend the 48,342 threshold proactively to keep the upward momentum intact. Friends, in the week before last, this index was ranked at number 6 based on statistical beta rankings that we maintain in-house. It jumped 4 notches to number 2. That's not good news. That means volatility actually went through the roof, and for retail guys, handling this kind of volatility is not easy. Last week, I advocated a range between 49,575 on the upside and 46,850 on the downside. Admittedly, the Bank Nifty exceeded my upper level by 400 points to go to 49,975 levels. In the coming week, I estimate a range between 50,300 on the upside and 47,550 on the downside. Friends, please also consult our daily, weekly and monthly pivot levels that I update on our free Telegram channel. The hyperlink to that channel is in the description and in the comment below the video. Friends, the Bank Nifty done. I now come to the Nifty 50, and this index gained 0.25 percentage point. It went up on only 2 out of 4 trading sessions, as you can see on the daily chart on your screen. But the difference was, unlike the Bank Nifty, which made a huge big bullish candle on Monday, the Nifty made a smaller gain on Monday. The price pierced the month-long moving average on an intraday basis on Friday, but managed to close higher by closing time. The moving average itself is appearing to flatline or lose upward momentum. Now, the 22,800 level is acting like a double top per resistance, which must be overcome forcefully on a sustained closing basis in order for the upward trend to sustain. Let's take a look at the weekly chart on our screen. What you are seeing is an inverted hammer on your screen there. It is bordering on being a gravestone doji. Now, this is the second inverted hammer in 4 weeks and fourth hammer itself, inverted or otherwise, in the last 5 weeks. That tells me that there's a tug of war prevalent between the bulls and bears, and there's a huge amount of churn taking place. The price is above the medium-term moving average, so the medium-term outlook is positive as of now. Now, here in this case, the bulls must defend that 22,348 level on every decline to maintain the upward momentum. Friends, in the week before last, this index was number 17 on the most volatile counters list as per statistical beta rankings in-house. It jumped 5 notches to number 12. Here again, the challenge level went up for traders. Last week, I advocated a range between 22,925 on the upside and 21,925 on the downside, which held perfectly well. In the coming week, I estimate a range between 22,975 on the upside and 22,000 on the downside. Friends, also watch the daily, weekly and monthly pivot levels that I update on our free Telegram channel. Friends, I now come to the last bit of statistical analysis wherein I give you the retail risk appetite by the turnover contributed in the 4 segments in the F&O space. In the futures space, both index and stock futures contributed lower turnover. As you can see, the index futures turnover is indicated as a blue line and the stock futures turnover is indicated as a red line. Futures demand more volatility, demand more capital by way of span and mark-to-market capital. Volatility is higher. So the fact remains that turnover contribution was less in the futures segment, tells you that risk appetite was lower. Index options, which are the least volatile and demand the least amount of capital involvement, were the only gainer in the turnover contribution metrics last week. It is shown as a green line. The relatively riskier stock options turnover went up by 50 basis points. It is indicated as a purple line. Very clearly, risk appetite was on the back foot. Friends, I now share my strategy, what I would do in the coming week. I think the week gone by was a very good one, especially for oil theta decay traders as well as linear short sellers. Gas prices rose as the European Union threatened to sanction Russian gas exports. And what you are seeing is 1.5% increase in spot delivery prices in Asia, and up to 5.5% increase in spot delivery cargoes in Europe. Europe is clearly more nervous as compared to Asia, but what we will need to do is monitor whether the transactions in the ready spot market, in the ready spot cargo market, both in Asia and Europe, are the transaction sizes big enough. If it is sporadic, scattered buying, I don't think you need to panic at all. I will continue to focus on public sector units or PSUs because of the above average market-wide position limits build-up which has been seen there. Now that means moves will be outsized because traders are emotionally, financially involved in these stocks. They've made large commitments. So they'll basically try and square up their positions much more aggressively because the trade sizes are bigger. For high-risk appetite traders, PSU stocks would provide good trading opportunities, but remember, leverage cuts both ways, so you need to be savvy at handling the risk and rewards. The other sectors that I would watch is power and energy stocks that I have been advocating since the last few weeks because crude oil prices have been on the go. Now, metal stocks will continue to remain more volatile and provide two-way trading opportunities because the underlying asset metals, primary metals in the commodity markets are showing a great deal of higher volatility. Bullion is witnessing consolidation and maybe even some profit taking, but it's been after a huge run up. So I think I would categorize this as a breather before bullion starts to sprint again. I expect lower levels to witness buying coming in for bullion from the stronger, especially institutional hands. I hope you've seen my video on bullion targets as well as another video that I've specially recorded for my online family about where and how to buy purest quality gold and silver at honest to God prices without actually getting cheated on the quality of gold that you're buying thanks to electronic testing, how to get it done, etc. The entire process in these two videos. Now, oil marketing companies are another sector you should watch because lower oil prices are usually positive for OMCs, barring overall market corrections, of course. Now, markets will be vulnerable to nervousness because of the data, rumors, views and news emerging on the election front. Now, what I would suggest is that you should basically trade on lower exposure levels because you'll have to grapple with higher volatility. Friends, if there are any more ideas that I need to share with you, I would be very glad in sharing them with you on our free Telegram channel. Do connect with me there. I thank you for your patience in being with me in this video till we meet again in my next. This is Vijay Bhambwani signing off for now. Take care. Bye-bye.